accounting for leases, by the lessor. The lessor in this case, remember, this is the owner of the asset. This is the owner of the asset, the owner of the asset. So how does this person here account for the lease? Now, the first thing the owner of the asset is required to do by this standard, by IFRS 16, is basically to classify the lease, to determine whether the lease is an operating or finance. So mean that even before the owner of the asset, the lessor can account for the lease, he need to determine whether the lease is finance or operating. Remember, you say that classification of the lease as operating or finance, it does not apply to the lessee. The lessee is required to recognize two items: the lease liability, the right of use asset. But you are saying that this person here, okay, so I'm told my board may not be clear. Just a minute, I check maybe. Okay, so in this case, what you're saying is that the owner of the asset, or basically the lessor for accounting purpose, is basically required to evaluate whether the lease is operating or a finance. Remember, we have said that that classification of the lease only applies to the owner of owner of the asset. So therefore, this person here, that is the owner, must first of all evaluate whether the lease is basically a finance or an operating lease, Now, according to this standard, according to IFRS 16, there are various criteria which can be used by the owner of the asset to determine whether the lease is operating or finance. And we have around 5 criteria, but 4 main criteria, or the 4 criteria are the ones which are main. So the first criteria which the owner of the asset can use to evaluate whether the lease is operating or finance is something called the option to buy, or basically the option to purchase. So in this case, the owner of the asset will need to determine whether the person who has leased this particular asset has been given the option, or basically the right to buy the asset at the end of the lease term. And if the lessee is given the option, or basically the right to purchase the asset, then this particular lease should be classified as a finance lease. So if, for example, I own an asset, I lease that asset to you, and basically we have agreed that at the end of the lease term, you can buy that asset, then in my books of account, as the owner, I should basically account for that particular lease as what? As a finance lease. On the other hand, if the lessee has not been given this particular right to purchase the asset at the end of the lease term, that one should be classified as an operating what? As an operating lease. So therefore, the first criteria here, which can be used by the owner of the asset in evaluating whether the lease is a finance or operating, is that particular option to buy, or the option to do what? To purchase. Number 2 is something called the transfer of ownership. So in this case, you may be told that these two parties, the owner of the asset and basically the lessee, have agreed that at the end of the lease, the ownership of the asset, or the legal title of the asset, will be transferred to the lessee. If there is such an agreement, then that particular lease should be classified as a finance lease. But if there is no such agreement, that the ownership or the legal title of the asset will be transferred to the lessee once the lease comes to an end, then that should be classified as an operating what? As an operating lease. So therefore, the other criteria which can be used by the owner is whether the ownership of the asset will be transferred to the lessee, whether the legal title of the asset will be transferred to the lessee. If it will be transferred, is a finance lease. If it will not be transferred, is an operating lease. The other criteria is basically the owner of the asset will compare two values: the present value of the minimum lease rentals and the fair value of the leased asset, asset. And basically, these two values should be compared at the inception date of the lease. The inception date of the lease, remember, we say that it is the date when the lease commences. Now, if at the date the lease commences, these two values are the same. the present value of the minimum lease rentals and the fair value of the leased asset are the same, then this one should be classified as a finance lease. Should be classified as a finance lease. But if these two values are not the same, this one is not equal to this, that lease should be classified as an operating lease, So the other criteria which still the owner of the asset can be able to use is the lease term. The lease term. Remember, in this case, we said the lease term is basically the period or is the number of years the lessee has been given the right of use. If I own an asset, I lease out that asset to you for a period of 5 years, then those 5 years will refer to them as what? The lease term. So in this case, we say that if the lease term is for the major part of the economic life of the asset, leased asset, then this one is a finance what? Lease. And basically, what do you mean by this? What do you mean by that the lease term is for the major part of the economic life or the economic remaining life of the leased asset? So in this case, what we do, we take the lease term, we divide that with the remaining economic life of the asset, and then we multiply that with 100. So in this case, if you get a rate which is 75% or more, then in such a case, we say that the lease term is for the major part of the economic life of what? Of the asset. Like in this case, we assume that the lessee here has leased an asset maybe for 3 years. And then in this case, we are told that the remaining economic life of the asset are how many years? 5 years. So we have taken the lease terms, 3 years. We have divided that with the remaining economic life of the asset, and then we multiply that with 100. So which percentage are we going to get here? Are we getting 60%? Will that give us 60%? Will that give us 60%? What are you getting here? Purchase growth. Yes. So it is giving us 60%. So in our case, you can see the rate which you are getting here is basically less than 75%. So if you get a rate which is less than 75%, that lease is always classified as an operating lease. If you get a rate less than 75%, in that case, we say that that is an operating lease simply because the lease term is not for the major part of the economic life or the remaining economic life of the asset. But if the rate which you get here is 75% or more, then that is a finance lease. Simply because the lease term is for a major part of the remaining useful life of what? Of the asset. And the last criteria, which is used by the owner of the asset to determine whether the lease is finance or operating, is number 5. We say if the leased asset can be used without major modification. So if, for example, you lease an asset, you can be able to use that asset without major modification. A good example here may apply to a building. You have leased a building, you can be able to use that building without major modification, then that lease we say is a finance what? Lease. But if you lease an asset, you have to do a number of modifications for you to be able to use it, then that is an operating what? Lease. So therefore, these are basically the various criteria which can be used by the owner of the asset to evaluate whether the lease is a finance or operating, of which according to IFRS 16, for a lease to be classified as a finance lease, it needs to meet at least one of these 5 criteria. So if a lease meets at least one of these criteria, then it automatically qualifies to be classified as a finance lease. If a lease has not met at least one of these 5 criteria, automatically it will be classified as what? As an operating lease. So then from there, how does now the owner of the asset proceed and basically account for these 2 types of leases? So let's start by looking on how the operating lease is accounted for. Accounting for operating leases. Number 1, operating risk. Operating risk. Remember, in terms of how we defined an operating risk, we say that this is basically a risk which does not transfer the rewards and the risks associated with the risk asset to who? To the lessee. So the owner of the asset, despite having risked out the asset, the risk associated with the asset, the reward associated with the asset basically remains with the owner of the asset. So therefore, under the operating risk here, the owner of the asset will not derecognize the risk asset, will not derecognize the risk what? The risk asset. So if you can be able to recall in the topic of financial instrument, we came across this particular term here, the term derecognition, and basically we say to derecognize an asset or basically a liability. This is a process of removing. This is the process of removing an item of asset or liability from the company's statement of financial position. So here we are saying that despite the company having risked out the asset, this asset will not be derecognized. It will not be removed from the entity's statement of financial what? Position. So here the company will continue accounting for that asset in its financial statement in the normal way, including depreciating that asset. Including depreciating that asset in the normal what? In the normal way. So what our company will account for here is the risk rentals receivable, of which this one will be accounted for by the owner of the asset as part of the other incomes. As part of the other what? Income. So basically what that means is that if you own an asset and basically you risk out that asset under the arrangement of the operating risk, you continue accounting for that asset in your statement of financial position. At the end of each year, you have to compute the depreciation for that asset. You recognize it as an expense in the income statement. And number two, the amount of the risk rentals you receive during that year, when preparing the statement of profit or loss, basically you recognize that as part of the other what? Incomes. And in this case, who can tell us these other incomes when preparing the statement of profit or loss? Where do we add these other incomes? Do we add the other incomes to the gross profit, or do we add them to the profit after tax? Because you have to recall, we have something called the other incomes and the other comprehensive incomes. Other incomes and the other comprehensive incomes. So these other incomes, where do we add them? Do we add them to the gross profit? Do we add them to the profit after tax? I'm told by Benson we add them to the gross profit. Is that the case? So I'm told by Reese, I'm told by Gilbert, we add them to the profit after tax. Where do we add these other incomes? Other incomes. Ruth, Patrice, where do we add these other incomes? Remember what you did in financial reporting, FR, that topic of preparation of the published financial statements. Are we adding these to gross profit or to profit after tax? So we don't add these. This one is not added to the profit after tax. Recall, we have other comprehensive incomes. We have other incomes. So other incomes, this includes things like investment income. This includes things like rent received. So other incomes, when preparing the statement of profit or loss, these ones are added to the gross profit. And then other comprehensive incomes, and other comprehensive incomes include things like what? The revaluation gain or losses on PPE, the revaluation gain or losses on financial assets at fair value through other comprehensive income. So these other comprehensive incomes, these are the ones which we add to the profit after tax. So therefore, this one, the rent received is part of the other incomes. We add it to the gross what? We add it to the gross profit. So therefore, in terms of how the owner of the owner of the asset, the lessor basically account for the operating risk, you can see that one is quite simple and straightforward. In fact, you'll never come across a question whereby you are required to demonstrate or maybe to illustrate how the owner of the asset was supposed to account for the operating risk. Maybe you can only get a theory question whereby you're required to explain how is the operating risk accounted for by the lessor or the owner of the asset. You'll never come across this particular question because we are saying if it is an asset under the arrangement of the operating risk, whatever you are receiving as the rent is what you recognize in your income statement as what? As part of the other incomes. That's that? Yes. So you'll never come across a question on this. So then from there, we proceed and look on how the owner of the asset account for the finance risk. So remember, he said under the finance risk, the owner of the asset will transfer the rewards, will transfer the risks associated with the asset to the person who is called the lessee. In other terms, we have said for any risk to be classified as a finance risk, it has to meet at least one of the 5 criteria which we have discussed. So if, therefore, the owner of the asset or the lessor leases out an asset under the arrangement of the finance risk, because he transfers the rewards, he transfers the risk associated with the asset. Number one, he is required, the owner of the asset is required, number one, to recognize. Is required to recognize the asset in the statement of financial position. What is to recognize? To recognize means that the asset which has been leased will have to be removed, from the lessor, from the owner's statement of financial position, simply because he has transferred the risk and rewards associated with that particular asset. That particular asset must be recognized. And then from there, the owner of the asset will proceed and recognize something called the net investment in the risk. The net investment in the risk, of which this one is still recognized as an asset. As an asset. He will recognize something called the net investment in the risk. What do you mean by a net investment in the risk? If, for example, today you own an asset, like maybe you own a building, and maybe you lease out this building to another person for the next 20 years, then in this case, we are saying because you're not deriving economic benefits associated with that asset, there is no way you will continue showing that building in your statement of financial position, because there is an accounting concept. This is something you did in financial accounting, known as the substance of a form. The substance of a form concept. So the substance of a form concept basically is an accounting concept. And this concept requires that a company should only account for an asset in its books of account if the company is deriving economic benefits. So if you're deriving an economic benefit from an asset, that is the only time you should include that asset within your statement of financial position. And actually, this particular standard, this concept, it applies to so many transactions. It applies to a transaction like hire purchase. If today you buy an asset through hire purchase, and you start using the asset upon payment of the initial deposit, because you are deriving economic benefit from that asset, though legally the asset does not belong to you until you pay the last installment, you should include that asset in your statement of financial position. You are deriving economic benefits. The same case, if you own an asset and you lease out that asset for the next 20 years, are you deriving economic benefit from that asset? Automatically no, because you have leased out that asset. So that's why we are saying, once you lease an asset under the arrangement of finance risk, you have to remove that asset. And that is in accordance with this particular in accordance with that particular accounting concept. And then from there, because over the next 20 years, you'll be receiving some rent, you'll be receiving some lease rentals, you need to recognize something called the net investment in the risk. The net investment in the risk, this basically is measured as the present value of the lease rentals receivable, So how much rent will be received over the lease term? Then you discount that. You discount that And then to this, you add something else called the present value of the guaranteed residue amount, amount. So what do you mean by guaranteed residue amount? Now, the guaranteed residue amount, this one only exists whereby, or you will only be given this particular amount whereby there is an agreement between the owner of the asset, the lessor, and the lessee that at the end of the lease term, the lessee can buy the asset, the asset. Because if these two parties, the owner of the asset, basically enter into an agreement with the lessee that once the lease comes to an end, this person can buy the asset. In most of the cases, the two parties will also agree on the price to be paid by the lessee when buying the asset. So in this case, like the two parties can agree that if this person will buy the asset at the end of the lease term, maybe he will buy that asset at 10 million. So that 10 million, we say it is a guaranteed residue amount. You see, residue amount we know is the value at which an asset can be sold at the end of its useful life. That is basically the definition of the residue amount, for example, in FM, which is also known as is it called the terminal cash flow? I think that is the other one used in what? In FM. So it is basically this the amount now to be received by the owner of the asset from the lessee if the lessee will buy the asset at the end of the lease term. So we discount it. And then to this, we also add the present value of an guaranteed residue amount. Unguaranteed residue amount. So in this case, when we talk about unguaranteed residue amount, this one basically arises whereby the owner of the asset expects to sell an asset at an amount which is higher than what the lessee has promised to pay when buying the asset at the end of the lease term. Like in this case, if the lessee has promised to pay maybe an amount of 10 million when buying the asset at the end of the lease term, the owner of the asset maybe expect that once the lease comes to an end, he will be able to get another buyer other than the lessee who will buy the asset at an amount which is higher than this. Maybe the other buyer will be able to come in and buy the asset at an amount of 12 million. So it is obvious that if the owner of the asset will be able to get this other buyer who will buy the asset at an amount of 12 million, automatically he will not sell it to the lessee. He will sell that asset to the other buyer who is willing to pay an amount of 12 million. But in this case, because there is no contract which is in place between the owner of the asset and this other buyer, then the difference between these 10 million and 2 million, the difference between these two values, this one and this one, the amount which this party has promised to pay, and the amount the owner of the asset expects to sell the asset at the end of the lease term, which is 2 million, this one we refer to it as the unguaranteed residue amount. The owner of the asset has not been assured by this other buyer that he will be able to buy the asset at 12 million, but there is an assurance from the lessee that he will be able to buy the asset at 10 million. So the difference between those two values, we refer to it as the unguaranteed residue amount. So therefore, this is basically how we determine the net investment in the lease. And once we have determined this particular amount, because it represents what the owner of the asset will earn, we receive over the lease term, then we have to do what? We have to amortize it. We gradually write it off such that at the end of the lease term, that net investment in the lease will be what? Will be zero. So, yes. So this is basically how the finance lease is accounted for by the owner of the asset. So, and I think with that, we can be able to proceed and look on a question. So I think we have one question which was tested on this, So let's go to the past papers. So let me pick my past papers. Yes, so the question I want us to do, yes, December 2022. We go to December 2022. Question 1B. December 2022. Question 1B. Question 1B. Question 1B. Question 1B. Question 1B. Question 1B. Are you there? Question 1B. Question 1B. Question 1B. Yes. Do you have the question with you? Do you have the question with you? Patrice, Ruth, do you have the question with you? Diana, do you have the question with you? Mercy, Miriam, Reese, Janet, do you have that question with you? Yes, yes. So what are we told? What are we told, sir? So we are told that 𝐎𝐿𝐶 Limited leased a factory to Tiena Limited with effect from 1st July 2022. So in that case, you can see we have two parties. And 𝐿𝐶 Limited, we are told, is the company which leased the factory to Tiena. So meaning 𝐿𝐶 Limited is the owner of the asset, or basically the lessor, whereas Tiena Limited is the lessee. So we are told the inception date of the lease is 1st July 2022. And then we are told the lease is for 4 years at an annual lease rentals of 4 million per annum, payable in arrears. The lease contract provides that the lessee shall be responsible for the insurance and maintenance of the factory during the lease term. And then you're told the interest, the implicit rate of interest in the lease is 15% per annum. So what are we required to do? We are required to demonstrate the suitable calculations, demonstrate with suitable calculations the accounting treatment of the above lease transaction in the financial statements of 𝐿𝐶 Limited, the lessor, for the years which ended 30th of June 2023, 2024, 2025, 2026, and the marks allocated there were 10 marks. A small question, but you can see the marks allocated there were significant marks, 10 marks. Now, basically what you're required to do is we demonstrate how this lease transaction will be accounted for in the books of account of who? In the books of account of the 𝐿𝐶 Limited, who is the lessor. Remember what you have said is that even before we proceed to demonstrate how 𝐿𝐶 Limited, who is the owner, of basically the lessor of the asset, the first thing we need to do as per this standard, as per IFRS 16, is basically to evaluate whether this lease is a finance lease or an operating lease. That is the first thing we need to do. And actually, for us to be able to do that, we are going to use one of the 5 criteria which we have discussed. The 5 criteria which we have discussed. And maybe based on the information which you're given here, which criteria can you be able to use to determine whether this lease is a finance or an operating lease? So you need to check information about whether there is any agreement about the transfer of ownership at the end of the lease term. We don't have that information, transfer of ownership. Information about the option to purchase or to buy the leased asset. Has Tiena Limited, the lessee, been given the right to buy this asset? There is no such information. Maybe information about the lease term. We are given the lease term 4 years. Are we given the remaining economic life of the asset? Automatically, no. The other information we can be able to use is about the present value of the minimum lease rentals and the fair value of the asset. So in that case, we are not given information about what? We are not given information about the fair value of the asset. Yes, I think the information which you're going to use in this case, this is talking about there is, okay, major maintenance cost. Yes, the information which you're going to use is what you're given in paragraph 3, where we are told the lease contract provides that the lessee shall be responsible for the insurance and maintenance of the factory during the lease term. So basically that comes from the word definition. Remember you have said a finance lease is basically that lease which transfers the lease and the rewards which are associated with the asset. And in this case, if, for example, you lease an asset and then you have the responsibility of carrying out the maintenance work, ensuring that particular asset, it basically means that the risk associated with that particular asset have been transferred to you. And therefore, if the risk associated with the asset have been transferred to you, to the owner, this is a finance risk. This is a finance risk. So therefore, maybe for your revision purpose, we can say that this is a finance risk. This is not basically a part of the solution which was required by the examiner, but this for your revision purpose. This is a finance what? A finance risk, since the risks associated with the asset, the risks associated with the assets, were transferred to the lessee. Were transferred to the lessee. The lessee in our case here is 𝐻𝐻 World Limited. This company has the responsibility to carry out the maintenance work and also to ensure that a building, the risks associated with that particular assets were transferred to the lessee. As a result of that, this will be a finance risk. This will be a finance risk. And therefore, I hope you can recall what you have said. If it is a finance risk, the owner of the asset here will, number one, recognize the asset, and then number two, he will compute something called the net investment in the risk. So therefore, what we need to do here is we basically proceed and we compute the net investment in the risk. The net investment in the risk, and actually this one is computed at the inception date of the risk. Inception date of the risk is the date when the risk commenced. And I hope you can see in the first sentence we are told, 𝐎𝐲 Limited leased a factory to 𝐻𝐻 Limited with effect from 1st July 2022. So this is the date when the lease commenced. In other terms, we refer to that as what? The inception date of the lease. So how do we compute this one? How do we compute this one? I hope you can be able to recall. I've given you the format of computing this one. And basically, you have said this is equal to the present value of the lease rentals receivable. The lease rentals receivable. And to this, we add the present value of the guaranteed residue amount. Guaranteed residue amount. And to this, we add the present value of unguaranteed residue amount. Unguaranteed residue amount. So then we add all this, which will give us the net investment in there, which will give us the net investment in what? In the list, which will give us the net investment in the list. Now, if you check on this particular question, the information which you are given here, is there anywhere we are given information about this? the guaranteed residual amount. Remember, we have said that the guaranteed residual amount, this is the amount to be paid by the lessee when buying the asset at the end of the lease term. Are we given any information about such an agreement that the lessee will buy the asset at the end of the lease term and the amount he will pay? Do we have such information? Do we have such information? Automatically, no. So in our case, we don't have this. Equally, there is no any information we are given about the unguaranteed. Remember, you have said unguaranteed residual amount. This will be the difference between the amount of money the owner of the asset expects to sell the asset at the end of the lease term and the amount of money to be paid by the lessee. So equally in this question here, there is no such information we are given. So meaning that this one, the net investment in the lease will basically be equal to the present value of the lease rentals receivable. The lease rentals receivable. So we are told the owner of the asset here leased an asset in sentence number 2 for 4 years. The owner of the asset leased the asset for 4 years. Year 1, year 2, year 3, year 4. And in this case, we are told the asset was leased out at annual lease rentals of 4 million, which is payable in arrears. Payable in arrears means that this 4 million, the owner of the asset will be receiving this at the end of each year. We'll be receiving that at the end of each year. So what we need to do is basically to discount that amount. So how do we discount this one? How do we discount this one? So we take 4 million, 4 million. We multiply this with the present value interest factor of annuity PVVA, at which rate we're given the rate in the last sentence at the rate of 15%, and basically for how many years? For 4 years. For 4 years. For 4 what? For 4 years. So let's work out this. Let's work out this. So I'm told by Gilbert that will give us 11 million. So remember the formula to be used in computation of this is this one. 1 minus 1 plus R raised to power negative N divided by R, and then we cross the bracket. We cross the bracket. We cross the bracket. We cross the bracket. Yes. So I'm given a figure of 11 million for what? 419, 913. Now, assuming this particular question here, this minimum lease rental is receivable in advance. So assuming, for example, this 4 million, our lease still is for 4 years, but the 4 million is receivable by the owner of the asset in advance. How do we compute this one? The present value of the minimum lease rentals receivable. How do we compute that one? If this amount was receivable in advance. Someone is saying that our N will be 3 there. Will be 3. Is that correct? So the only change would be our N. The only change would be our N. And when discounting then, do we include this one? When computing this one, the present value of the minimum lease rental. So do we include this 4 million? Do we include the 4 million? I'm told by Patrice, no. Do we include 4 million, which was paid at the start of year 1? In this case, we do include that. But basically what we do in this case, if this amount was receivable at the start, we take 4 million. 4 million times the PVVA, which is basically this one, 1 minus 1 plus R raised to power negative 4 still, raised to power negative 4, and then divided by R But because this one is receivable in advance, we do a small modification to our formula. 1 plus what? 1 plus R. So that's what you do when discounting this. But remember, we say this, that this one does not apply. This one does not apply to the receipt, because we said whenever the receipt is computing the risk liability. I hope you can remember that formula. We said what the receipt should discount is the minimum risk rentals not received at the inception date of the risk. Yes. So therefore, if this amount was receivable at the start, that is how basically you discount it. That's how you do what? You discount it. You discount it. Alternatively, you can use another approach, because there are so many approaches of computing this. You can take 4 million. 4 million, the present value of this is the same. See, the present value of 4 million, which was received at the start of the day, is 4 million. If you're to discount this 4 million received at the start, see, its present value should be 4 million. Yes, it should be 4 million. And then now you discount these three amount. These three amount. You take now 4 million. 4 million. You multiply that with this 1 minus 1 plus R, which is basically 1.15. And then now our n here will be 3. Will be 3 divided by 0.15. So if you work out this using either of this or this, you should get the same answer. The same word, the same answer. Yes. So you may come across a question whereby these minimum risk rentals are receivable in advance. So if you're receivable in advance, in computing the net investment in the risk, you have to include this. Yes, I hope that is well understood. So if that is the case, then let's move and we compute this one, the net investment in the risk, which is 11,419,913. Now, having that, we need to move and we do what? We amortize this net investment in the risk, because we are saying this net investment in the risk represent what the owner of the asset, the lessor, will basically receive over the risk term. So what do we need to do? We need to amortize this one. We need to amortize that. So we prepare the risk amortization schedule. The risk amortization schedule, we gradually write off that assets over the risk term. We gradually write off this. So the first column here will be for the years. Remember, you have 4 years. The next column will be for what? Net investment in the risk at the start. Net investment in the risk. Let me just put that as the opening balance. Balance brought down, which is the net investment in the risk at the start. Then the next column here, it basically depends with when these minimum risk rentals are receivable. So if they're receivable at the end, the next column here should be for the interest. And remember, in this case, because this is an investment, the owner of the asset has invested in the risk. This will not be an interest expense, but rather this one would be an interest income, which will be computed at the rate of 15%. The owner of the asset has invested in the risk. He will be receiving some income, or basically this will be an interest income. Then the next column here will be for what? Will be for this risk rentals receivable. Risk rentals receivable. In other terms, we can refer to that as the cash to be received annually. The cash to be received. And the last column here will be for the balance carried down. The balance carried down basically will be what? Will be the net investment in the risk at the end of each year. The net investment in the risk at the end of each what? Year. So let's prepare this one. We prepare this risk amortization schedule. This risk amortization schedule, and we are preparing this for how many years? 4 years. So if we go to the requirement, we are specifically given our 4 years. The first year is the requirement added on that year of June 2023. That year, June 2024. That year, June 2025. And that year, June 2026. So the net investment in the risk at the start of year 1 is what we have computed here. This is the net investment in the list at the start of year one. That is the amount we want to amortize. 11,419,913. So what we need to do is we compute the interest being 15% of this. So how much would be the interest? 15% of this. 15%. Yes, I'm given 1712. 987. Okay, then from there, the cash received at the end of year one is this one. The cash received at the end of year one, 4 million. 4 million. And then we determine the net investment in the list at the end of year one. So this net investment in the list at the end of year one will be equal to the net investment in the list at the start plus interest minus the cash received. So this one will be equal to A plus B minus C. So that's I'm told by Gilbert will give us what? 91,32,900. Is that what you're getting? Yes, that is also the figure I'm getting from Mercy. Are you getting the same? 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 Yes, that is also confirmed. That is also confirmed by Miriam. Okay, so then that would be the opening balance in year two. 91,32,900. And then we compute the interest being 15% of this. 15% of that amount. 15%. 13. 68,935. 935, is that what you're getting? Yes. No. I'm told is what? I'm told is 1369. 1369. 935. Okay. So the cash received at the end of year two is basically what we have here, 4 million. And actually, in computation of the net investment in the list, this one is always taken as a deduction. So I'm told that will give us a net investment in the list at the end of year two, 65,02,835. 835. That would be the opening balance here. 65,02,835. So how much will be the interest then? The interest, 15% of this. Yes, I'm told by Gilbert will be 975 for 25. So the cash to be received still remain 4 million. The cash to be received at the end of year three, 4 million. So what will be the net investment in the list at the end of year three? I'm told it will be 34, 78, 6 what? 6. That is 260. That is 260. 260. So then that will be the opening balance here, which is the 34, 78, to what? 260. The interest in the last year, the interest in year 4, interest income in year 4, 521,739. Okay, so then here we compute the cash received. The cash received, actually that one we already have it. We don't have to compute, which is that one, 4 million. 4 million. And what are you getting is the net investment in the list at the end of year 4. at the end of year 4. At the end of year 4. At the end of year 4, this one should be 0. That one should be 0. That one should be 0. Because basically what we have done, we have now fully amortized our net investment in the risk. Now, have we answered our question? Is that what the examiner was requiring? Is that what the examiner was requiring? Yes or no? Is this what the examiner was requiring in this question? For us to be able to get the 10 marks. See what we are required in the requirement. We are required to demonstrate with the suitable calculations the accounting treatment of the above risk transactions in the financial statement. So we have not yet answered our question. We must demonstrate how this risk transaction was supposed to be accounted for in the financial statement of this company for the 4 years. We do that by preparing the income statement extract, by preparing the statement of financial position extract. We show what was supposed to be recognized in the income statement and what was supposed to be recognized in the statement of financial position. So let's do that now. We do that, and automatically we are going to start by preparing. We will start by preparing the income statement extract. The income statement extract. And basically we show what was supposed to be recognized here as far as this transaction is concerned for the period of 4 years. So let's have our 4 years here. The first year ended 30th of June 2023, 30th of June 2024, 30th of June 2025, 30th of June 2026, like that. Now, who can tell us from the computation we have here, what was supposed to be recognized in the income statement of this company? From the computation we have here, who can tell us? What was supposed to be recognized here, Mercy, Diana, Georgina? What was supposed to be recognized here in the income statement of this company? Yes, I'm told interest income. So this interest income should be recognized in the income statement as part of what? This one should be recognized as part of what? Yes, I'm told by Diana, this one should be recognized within the income statement as part of other incomes. As part of other income. So within or in the income statement, this interest income will be recognized here as part of other incomes, as part of the other incomes, So under the other incomes, the company was supposed to recognize interest income. And the interest income, this one can also be known as the investment income. Remember, our company has invested in this risk, has invested in terms of leasing out an asset. So the investment income in the past year is 17,987. For year 2 is 13,69,935. Year 3 we have 975, 425, and finally we have year 4, 521, 739. So that is the only item which was supposed to be recognized in the income statement. So finally, we prepare the statement of financial position extract. Statement of financial position extract, and basically we show what was supposed to be recognized here. What was supposed to be recognized here in the statement of financial position, also for the 4 years. 30th of June 2023, 30th of June 2024, 30th of June 2025, 30th of June 2026. Now, remember what we have said is that this company will be recognized. This asset which was leased out will be removed from the balance sheet of the company, from the statement of financial position, and then our company will recognize here something called the net investment in the risk, of which this net investment in the risk is supposed to be recognized here as an asset. As an asset. Someone is raising the hand. I don't know whether it is a question. Is it a question, Mercy? I can see your hand is up. Do you have a question, Mercy? Any question? Okay, sawa. So let's continue. So we are saying that this net investment in the risk will be recognized here. Will be recognized here as what? Will be recognized here as an asset. Someone is asking, why are we not recognizing the risk payment as an income? No. So you don't recognize this as an income. You see, this is cash which is being received. So according to the accrual concept, in the income statement, you don't recognize the cash you have received as an income. Sasa, you recognize the income for that year. The income for that year. So the income associated with this particular list is not the cash received, but the interest income. Interest income is the income generated or associated with that word list. That word should be recognized here, not the cash received. Sasa, and that is in accordance with the accrual or matching concept. Whatever you recognize here is the income associated with the list, not the cash you received. Not the cash you receive. The same way, if for example you are paying, you have an expense for a certain year, do you recognize the cash you paid in the income statement, or do you recognize the expense for that year? Maybe you should pay a rent of 200,000 in a year, but during that year you paid 150 as the rent. What do you recognize in the income statement? 150 or 200? You recognize 200, the rent for that year. Yes, that is in accordance with the accrual or matching concept. Yes. So let's come back here now. What we are saying is that this net investment in the risk will be recognized here as an asset, but just like what we did at the when we were accounting for the risk liability, this one should be split into two. This asset should be split into two, into non-current assets and current what asset, because basically this shows the amount of money which the owner of the asset will basically be receiving from this risk. So part of it will be received for a period exceeding 1 year, and that one is a non-current liability. Part of this amount should be received within 1 year, and which is a current liability. So therefore here, this net investment in the risk will be split into two. So we will have part of the net investment in the risk being recognized here as non-current assets. Under the non-current asset here, we will have something called the net investment in the risk. Net investment in the risk. And then still under the current assets, we will still have net investment in the risk. Net investment in the risk. Now, in terms of how we split this, is the same thing we are doing when splitting the risk liability. When splitting the risk what? Liability. For example, we can start by determining the amount to be recognized here as current asset. Current asset, basically, this is the net or the amount to be received by the owner of the asset within the next 1 year. Within the next 1 year. And that amount to be received within the next 1 year would be this decrease. You can see our net investment in the risk is actually reducing each year. That reduction represents the cash received. So therefore, can we determine the difference between these two values, this and this? That is the amount to be recognized here in the first year as a current asset. It is the amount to be received by the owner of the asset within what? Within the next 1 year. Within the next 1 year. The difference between this and this. So I'm told it's 2,630,065. 065, is that what you're getting? That is a figure I'm getting from Diana. That is a figure I'm getting from Gilbert. I presume that is correct then. I presume that is correct. Then what is the difference between this and this? Net investment in the risk at the end of year 2 and year 3. The same amount? Okay. I'm told it's 3,024,000 575. 575. Okay. And then here in year 3, we get the difference between this and this. This and this, which should be 34, 78 to 60. And then automatically in the last year, year 4, the net investment in the list will be 0. Will be 0 here. Yes. So that is basically how we determine the amount of net investment in the list to be recognized here as a current asset. Then, how do we determine the amount to be recognized here as an non-current asset? The same thing we're doing at the list liability. So the amount to be recognized as an non-current asset at the end of year 1, 2023, we take the net investment in the list at the end of year 2. At the end of year 2, this one. 6502 835. We do the same here at the end of year 2, 2024. We take the net investment in the list at the end of 2025. That one. 3478 to 60. And then at the end of year 3, we take the net investment at the net investment in the list at the end of year 4, which is basically 0. Here we do the same, the net investment in the list in year 5, which is equally nil. So that's basically how this company was supposed to account for this risk transaction in its books of account, So you can see that question was, or basically that is what was required. And that's why you can see the question I'd give, the marks allocated there were 10. And this is now what is marked. This is what give you the 10 marks. The 10 marks. But also, I think in computation of this, in computation of the net investment in the list at the inception date, there must be some marks allocated to that. There must be some marks allocated to that. Yes. So that is it. That what was required as far as that question is concerned. I want us to just take a short break, and then once we come back, there is still a small illustration within the handout which I shared with you. A small illustration within the handout I shared with you, and that small illustration is basically what I want us to do once we come back after the short break, because that illustration has the guaranteed residue amount and also unguaranteed residue amount. Remember, in this question, we didn't have the guaranteed residue amount and the unguaranteed residue amount. So you can be checking on that small illustration within the handout. That's what I want us to do after the short break. So let's just take a short break. We come back after just a short break of 5 minutes. 5 minutes. That small illustration. Yes, so let's continue. I hope you have the illustration with you. I've already shared that handout in the class WhatsApp group. Are you there? Do you have that small illustration with you? If we are there, maybe just confirm so that we go through it. Yes, that is confirmed by Gilbert, by Diana. Yes, Benson, uko na swali. Do you have the question? Mercy, Maureen. Yes, Frida, do you have the question with you? Karaja, this. Okay. Okay, so what are we told here? What are we told? Basically, a small question. We are told RSO, that is the owner of the asset, enters into a 3 years leasing arrangement commencing on January 2013. Under the terms of the lease, the lessee commits to pay shillings 80,000 per annum, commencing on 31st of December 2013. And then you're told a residual guarantee clause requires the lessee to pay shillings 40,000 at the end of the lease term if the lessor is unable to sell the asset for more than shillings 40,000. The lessor expects to sell the asset based on the current expectation for shillings 50,000 at the end of the lease term. So the interest rate implicit in the lease is 9.2%. So what are we required to do? We're required to show the net investment in the lease from 1st January 2013 to 31st of December 2013. 15 and explain what happens to the residual value guarantee on 31st of December 2015. So this particular question here has the two aspects, the aspect of guaranteed residual amount and the unguaranteed residual amount. So what we are required to do here is basically we show the net investment in the risk from the inception date of the risk to the end of the risk. So we start by computing the net investment in the risk. We start by computing the net investment in the risk. The net investment in the risk at the inception date. The inception date of the risk is 1st January 2013. The inception date is the date when the risk commenced. So how do we compute this one? Net investment in the risk at the inception date. So we add three values: the present value of the minimum risk rentals, which is receivable. To this, we add the present value of what? The present value of guaranteed residual amount, the guaranteed residual amount, and then to this we add the present value of unguaranteed residual amount. That's basically how we determine the net investment in the risk at the inception date of the risk. So for us to be able to discount this, the first thing which is important for you to appreciate is the information which you're given. So we are told that this risk is for how many years? This risk is for 3 years. Year 1, year 2, year 3. And basically the owner of the asset who is the lessor, or actually in sentence 2, we are told at the terms of the risk, in sentence 2, at the terms of the risk, the lessee, the person who has been given the right to use the asset, commit to pay 80,000 per annum commencing on 31st of December 2013. So meaning that this 80,000 will be paid at the end of each year. In other terms, the owner of the asset will be receiving this at the end of each year. And then in paragraph 2, we are told the lessor expect to sell the asset. Before we go to that, paragraph 2, that is, a residual guarantee clause requires the lessee to pay 40,000 at the end of the lease term if the lessor is unable to sell the asset for more than 40,000. So basically, it means that if the lessee will buy the asset at the end of the lease term, he will pay an amount of how much? 40,000. So this 40,000, we refer to that as the guaranteed residual amount. Guaranteed residual amount simply because the owner of the asset is assured that if the lessee will buy the asset, he will pay how much? He will pay 40,000. But in the last paragraph, we are told the owner of the asset expect to sell the asset based on the current expectation at 50,000. So what we need to do in that case is basically we determine. Remember, I've said that this is the guaranteed residual amount. We need to determine the unguaranteed residual amount. So in this case, who can tell us what would be the unguaranteed residual amount based on what I have printed? How do we determine the unguaranteed residual amount? The unguaranteed residual amount, we said, is the amount at which the owner of the asset expects to sell the asset at the end of the lease term minus the amount to be paid by the lessor when buying the asset. So the unguaranteed residual amount here is 10,000. So therefore, we need to discount all those values there. So we will start by discounting the minimum risk rentals receivable. So the owner of the asset is expecting at the end of each year, he will be receiving 80,000. So we multiply that with the present value, interest factor at the rate of 9.2%, and basically for 3 years. That will be received for 3 years. And then the guaranteed residual amount is 40,000 40,000. We multiply that with the present value, interest factor, not the interest factor of annuity. This is the interest factor of annuity. This one is not for annuity because this is not an annuity at the rate of 9.2 and basically for 3 years. And then the unguaranteed residual amount is 10,000 times the present value interest factor at the rate of 9.2%, and then for 3 years. Or basically, this one will be received at the end of the third year. At the end of the third year. So basically, what is important for you to recall here is the formula. How do we compute this one? This one is computed using this formula, 1 plus r raised to power negative n. This one, the PV is computed using this formula here, 1 minus 1 plus r raised to power negative n. We divide all that with r. Sasa, yes. These are annuity, these are lump sum, is a single amount to be received at the end of the fourth year, including this one, including that one. So remember, you said in a fund, you must remember these formulas because you'll not be given those present value interest factor tables. Even if you're given, you can see the kind of the rate we're given here. The rate we have here, the rate of 9.2, that is, you can't get that in the table, in those particular tables. You must use the formula here. Yes, so what I get in here, so we should compute this one using this formula, 1.092 raised to power negative 3 times 10,000. 70, 76, 79. What about here? 30. Is it 30? Huh? Are my figures correct? 3718. What about this one? The present value of the minimum lease rentals receivable. This one. Yes, I'm given 201. 201,787. 787. Then give me the total. Give me the total down there. The total, the net investment in the lease. The net investment in the lease at the inception date. Net in the investment in the lease at the inception date. Yes, that's this one I'm given 240, 241.82, 241.82 to 182. Okay, so let's move and quickly prepare we amortize this one. We need to amortize this by preparing the lease amortization. The lease amortization schedule. Basically, we amortize that net investment in the lease. Net investment in the lease. So our we need to have 3 years here. That basically will be our first column. Our first column here. Then we will have the net investment in the lease at the start of the year, balance brought down. The next column will be the interest income. Interest income, which will be computed at the rate of 9.2%. The next column here will be for the cash to be received by our company, the cash to be received by the lessor, and then finally the net investment in the lease at the end of each year. At the end of each year. So the first year basically started on 1st January 2013. So mean that the first year will end on 31st December 2013. The other year, 31st of December 2014. The other 31st of December 2015. Is it 20? That is, yes, 2015, like that. Okay. So the net investment in the risk at the start of first year is 240, 182. So what would be the interest? Being 9.2%, being 9.2%. 9.2% is what? 9.2% will give us what? Will give us what? Will give us what? What wamechoka? So let's wait up on this. Let's wait up on this. Yes, I'm given by Mercy here, 22,097. Yes. So then the cash received at the end of year one is basically what we have here. Our company received 80,000. The restaurant received 80,000. So therefore, the net investment in the list at the end of year one would be equal to our A plus B minus C. A plus B minus what? Minus C. So which will be equal to 182, 279. Yes. So then that would be the opening balance here. 182, 279, 279. So what would be the interest income? 9.2% of this. 9.2%. Yes, 16. 770. The cash still received here is 80,000. This one, 80,000. So the net investment in the list at the end of year two, 119,049. That will be the opening balance here, 119,049. So what would be the interest? The interest I'm told will be 10,952, 953. 953, yes. And then here, how much cash will be received here? How much do we include in these columns? Who can tell us? How much amount do we include here? The cash to be received? How much cash will be received there? I'm told 130,000 by Diana. 130,000 by Diana, that is what I'm given here. 130 by Frida, 80. 130. Yes. So now, in preparing the amortization schedule, the amount which you're going to include here will basically be 80. Reason being, we know that at the end of the lease term here, that is at the end of the fourth year, the owner of the asset will have to sell the asset. Are we given any information in the question the asset was sold? Are we given any information that the asset was sold? There is no way we're given that information. And that's why in the question, if we go back to the question, in the requirement, we are told it shows the net investment in the lease from 1st January 2013 to 31st of December 2015 and explains what happens to the residual guaranteed value on 31st of December 2015. You explain what will happen to the residual value. So meaning that in this case, just include this one. And then automatically the balance here should be 50. Should be 50,000. So is that what you're getting there? 50,000. That's what you're getting as a 50,000? Yes. So then you explain what will happen to this. So what basically you say here is that this 50,000 is the amount to be received. Amount to be received by the owner of the asset, by the owner of the asset, after selling the asset. After selling or basically disposing the asset after selling the asset. So that is the amount he will receive. That is the amount he will receive because we are not told the asset was specifically sold. That's why you are required to explain what will happen to that amount. Sasa, yes. So that is it. That's what is required. And then what I'll do, I'll give an assignment. Can you also prepare financial statement extract? You prepare the financial statements, what? Extract. In this question here, prepare, number one, the income statement extract. You show what was supposed to be accounted for by our company there. And also you prepare the statement of financial position extract. You show what was supposed to be recognized there. Sasa, it's just the same with what you have done in the other question, what you have done in the other question. And basically for today, we will stop at that point. Once we meet now in our next class, we will be winding up with this topic by looking on something called the sales leaseback transaction. Sales leaseback transaction. Remember, this is basically a totally new concept. A totally new concept. A concept which was not covered in a PAR, CP intermediate level. So we are going to look on how we account for something called the sales leaseback transaction. Sales leaseback transaction. Maybe just to mention, a sales leaseback transaction, this whereby the owner of the asset will sell the asset, basically to a certain buyer, and immediately lease back that asset. Asset. Usually this happens whereby maybe a company, like this case, the owner of the asset, assuming it is a company, that company maybe own a building, and this company wants to raise some capital to invest in a certain project. And maybe the company is not in a position to go to the bank to acquire maybe something like a bank loan, or the company is not in a position to issue shares or even to issue debt security. So the company may decide to sell this asset, this building, but because the company is still using it, the company agree with the buyer that the asset will be leased back immediately by the company. So meaning that the buyer here buy this building, but immediately leases back that particular asset. What just happens here, the asset continue being used by this company. What happens is that the ownership of the asset changes. The ownership moves to this to this person here. Now this company here which sells the asset is called the seller. This company which buys the asset is called who? The buyer. But because this buyer becomes the owner and he leases out the asset to this person is also called, or he becomes the lessor. He becomes the lessor. So therefore, this person who buys the asset immediately leases back that asset. We refer to this person as the buyer lessor. This company here, which sells and leases back, this company is called the seller lessee. The seller who? Lessee. So therefore, in a sales leaseback transaction, we will be able to see that we have two parties. We have the buyer lessor, and also we have the seller lessee. In this case, we are going to look on how this transaction is accounted for, both in the books of account of the seller lessee and also in the books of the buyer lessor. But this is something I want us to discuss once we meet in our next class, and we will also be able to look on two illustrations as far as the accounting for this transaction is concerned. So therefore, for today, I want us to stop at that particular point. I don't know whether there is any question before we wind up. Do we have any question? Do we have any question before we wind up? Any question before we wind up? And I hope up to that point, the progress is okay. Is there any challenge up to that point? Is the going okay up to that point? No, but Frida, Patrice, Faith, is the going okay up to that point? The status of the syllabus coverage. Syllabus coverage, we are on track. We should be able to finish the syllabus by the third week of July. We should be done. with the syllabus by the third week of July, because I think the key topics now which are remaining, other than the group, we will automatically end up with the finish with the group, the topic of how do we prepare this one? We prepare this based on the accounting equation. The accounting equation we states that if you take assets are plus what? Liability. So therefore, in preparing this, we start by recording assets, and then you also have to record that assets are classified into two: the non-current assets and the current assets. I was able to explain what you mean by the non-current asset. We say that these are the assets which are acquired by the business to help the business in terms of generating revenue or in terms of generating what? Income. If, for example, you have a business, you may decide to buy a motor vehicle. That motor vehicle is to help you in your business to make revenue. So these are the assets acquired to help a business to generate revenue. And number two, we say these assets are expected to be used in a business for a period exceeding 1 year. Now, current assets are the assets which are related to the trading activities of the business, e.g. inventory, e.g. receivables, e.g. cash, e.g. bank balance. And these assets are expected to last for a period less than 1 year. So we will start by recording assets, which we classify into two, non-current and current. And then from there, we record capital. And then finally, we record liabilities. Liabilities equally are classified into two, non-current liabilities and current liabilities. So we start by recording assets here. We start by recording what? Assets. And basically, we always start by recording the non-current assets. The non-current assets. The non-current assets. So in this case, we just need to have a single column here. And I hope you can also be able to record the figures which were given in the trial balance. Yes. So we just need to write that our figures will be in thousands of shillings. So what we need to do is we go back to the trial balance. We check the non-current asset. Non-current asset, I've said, is an asset which is acquired by the business to help the business in terms of generating revenue. These include assets such as land, buildings, motor vehicle, furniture and fittings, and so on and so on. And this is also something you need to recall from what we covered in the topic of the ledger account. In the topic of the ledger account, I was able to explain what are the assets and so on. So therefore, from the trial balance, I think we have a number of assets. Can we go down there from where we have landed buildings? Can you see landed buildings? Yes. So I hope you can see landed buildings. Land and buildings. Land and buildings. So the value for landed buildings there is what? Is 2,550,000. Now remember the format which I gave you. We say that when recording the asset here, that is the non-current asset, we record them here at the net book value. At the net book what? Value. So how do we compute the net book value of an asset at the end of the year, which is basically recorded here? The net book value of an asset at the end of the year is equal to the cost minus the accumulated depreciation at the start of the year. And the accumulated depreciation of the asset at the start of the year are the accumulated depreciations which we have in the trial balance. If you check on the trial balance which are given here, the last items down there, you can see we have accumulated depreciations. Those are accumulated depreciations at the start of the year, which are part of the trial balance. So other than deducting this accumulated depreciation at the start, we also less the depreciation for the current year. Depreciation for the current year. And basically, this is the depreciation which is in the statement of a profit or loss. So that depreciation which we accounted for as an expense in the statement of profit or loss is the depreciation for the current year. So therefore, it's very, very important to note this. How do we compute net book value of the asset at the end? Take the cost minus accumulated depreciation at the start, which is in the trial balance, minus the depreciation for the current year, which is in the income statement or the statement of profit or loss. Now, if you check the depreciations which are in the trial balance down there, you'll be able to see those are depreciation for plant and machinery, motor vehicle, furniture, and fittings. So meaning that we don't have any depreciation for landed buildings. So basically, there is something I mentioned in our previous class. There are those assets which do not lose value. Like if you have land do not lose value. In fact, land appreciates. The value of land keep on increasing. So that's why you can see there is no depreciation for this. But if there was depreciation, then we would have taken the cost, which is 2,550,000, minus the accumulated depreciation at the start, basically, which is 0, minus the depreciation for the current year, which is equal to what? 0. And then in that case, we get the net book value at the end of the year. In this case, the net book value of landed buildings remains the same. Remains the same. I want us to move to the other asset, which is below landed buildings, and that is plant and machinery. Plant and machinery. So we will use this approach. So we take the cost, which is in the trial balance, 1,600,000. And then I want us to use this formula. We must be together here so that you understand this. So this is the cost. Whatever you have here is the cost. I want us to just the accumulated depreciation at the start, which is in the trial balance. So who can tell us how much is the accumulated depreciation for plant and machinery in the trial balance? How much is that figure? Down there in the trial balance. Down there in the trial balance, the accumulated depreciation at the start for plant and machinery. Yes, it is an amount of 447. Please, once you get the answer, type it in the chat box. Once you get the answer, type it in the chat box. Yes, so that I know whether we are together. Are we moving together or we are lost? The Morim can only be able to know that this is where we are communicating in the chat box. That's where we communicate. Yes, once you get the answer, type it there. That's the only way I can be able to know whether we are together. Yes, so the accumulated depreciation at the start is 447,010. And then to this we less the depreciation for the current year. This is the depreciation which we computed as per note number 6, and also the depreciation which we recognized as an expense in the income statement. So who can give me that depreciation? For this one, I think it was 400,000. Was it 400,000? The depreciation from the income statement for the current year? Yes or no? Is it 400,000? Is it 400,000? I'm only getting answers from Evans. The depreciation for the current year. Ukienda kwa income statement, you'll be able to see we have depreciation which is recognized as an expense. Is it 400,000? Yes. So that's basically how we compute the net book value. So before we do this, I want us to do the same for the other assets, because we also have other non-current assets, including motor vehicles. We will do the same. We take the cost, which is 843,000, minus the accumulated depreciation at the start of the year, which is in the trial balance. In the trial balance is a figure of 168,600. And then can you give me the depreciation for the current year? The depreciation for the current year from the income statement. The depreciation for the current year in the income statement. Give me that figure. Give me that figure in the chat box down there. You just need to go back to the income statement and you check how much is the depreciation for the current year. How much is the depreciation for the current year for motor vehicles? The one which we computed, it was 168,600. So do we have any other assets? I can't see any other. Asset. Any other non-current asset. So I think we have only those three. So what we need to do here is we compute now the net book value. So let's start with the plant and machinery. I will take 1.6 million minus 447,010 minus 400,000, and I'm getting 752,990. 900. Oh, there is one which has skipped. Okay, I've not seen that one. Furniture and fittings. Yes, furniture and fittings, I've seen it. Yes, thank you for that. Furniture and fittings. We do the same. We take the cost, which is the 245,000. We less the accumulated depreciation at the start, which is in the trial balance 14 to 40. How much was the depreciation for the current year? The depreciation for the current year from the income statement. The depreciation for the current year from the income statement in Esther, Benson, Paul, 625. That is 625. Okay, so having that now, can we compute these net book values? Let's compute these net book values. We compute these net book values. So confirm whether you have gotten that one for plant and machinery. Have you gotten 752,990? Yes. So we move now to the other one, motor vehicle. We have 843 minus 168.6. These two are the same. The accumulated depreciation at the start and also for the year. They are the same. These two figures here. Are they the same? For motor vehicle, the accumulated depreciation at the start and for the year. They are, right? Okay, sawa. Okay, so let's get the net book value at the end. So I'm getting 505,800. 505,800. What about furniture and fittings? 245 minus 14.24 minus 30.625. And that will give us 135. So therefore, that's basically how we compute the net book value of the assets, of the non-current assets at the end of the year. This formula is very, very important. You need to remember that formula moving forward. So if formula write it somewhere, right? This formula somewhere is very, very important. This is now what we will be using moving forward. Okay. So having that, then we need to proceed and we record the current assets. The current assets. Now, for the current asset, we said are assets related to the trading activities of the business. These include assets such as inventory, cash at bank, prepaid expenses, and so on. So, which asset do we have? And recall, we said once you go to the trial balance, and you're looking for assets, where do you look for this particular asset in the trial balance? Which column? Evans. Where do you check for this asset in the trial balance? Esther, Rin, Hussein, where do you check for the asset in the trial balance? Yes, we said you check them in the debit column. In the debit what? Column. If you can be able to remember that, that will make your work very easy. Will make your work very easy. Will make your work very easy. Very easy. Very easy. Sasa? Yes. So let's check the items on the debit column. After we have purchases which we dealt with in the income statement. Down there, you can see return inwards, discount allowed, downstairs salaries and wages, rates, insurance, general expenses. All those are expenses, but we have trade receivables. Trade receivables. This is the amount of money expected from the debtors. So the trade receivables amount is the 552,000. But this amount, the reason why I'm writing it here is because it will have some adjustments. If you check on the workings we did, we said that there are two items which are to be adjusted to this. If you can be able to recall those workings which we did. The first adjustment to be made to this is the working which we did in relation to note number 4. In relation to note number 4, can we go to note number 4, additional information number 4? We are told the trade receivables include an irrecoverable amount of 84. So we said that irrecoverable amount should be deducted from this because out of this, the company expects that it will not be able to recover an amount of 8,400. We need to less it here. Then also in note number 5, we computed allowance for doubtful debt, which we said we recognize as an expense, and number 2, we also deducted here. So who can give me that allowance for doubtful debt? The allowance for doubtful debt which we computed as per note number 5. As per note number 5, how much was that? It was 27,180. So that's basically how we get the net amount of receivables. The amount which was written off and the allowance. So the allowance, we say, is an amount which is set aside to cater for the losses to be incurred once the customer fails to pay. It is recognized as an expense and also it is deducted from receivables. So this will give us a net amount of 516 for 20, 516 for 20. So confirm whether that is what you're getting. Is that what you're getting? Please confirm. I want us to finish this question and we do another one. We must do another one because I want us to wind up with this topic today. Is that what you're getting, Lynn? Is that what you're getting, Benson? Esther, is that what you're getting, Hussein? Is that what you're getting? Eunice? Paul? Yes. So then, what else do we have? Which other current asset do we have? Remember, we are taking the items appearing on the debit column. So below the receivables down there, I'm not interested with the items appearing on the last column of the trial balance. Those items cannot never be assets. Down there, you can see inventory. Inventory, which you record there, here is the closing, not the opening, because that is the opening. Below that, we have plant, motor vehicle, drawings, furniture. None of those is a current asset, but we have cash. Cash, that is a current asset, and that is an amount of 300. Then I can't see any other. Can we go to the additional information now? In the additional information number 1, we have the closing inventory, the inventory at the end of the year. The closing inventory here is recognized as a current asset. So the closing inventory at the end of the year had a value of 600. And then below that, we have some rates which were paid in advance. So we said any expense which is paid in advance is a current asset. Any expense paid in advance. So we have prepaid rates. Prepaid rates, in that case, is an amount of how much? 10,500. 10,500. And then from there, we have note 3. Note 3, we have outstanding electricity. Outstanding electricity basically is an expense which has not been paid. An expense not yet paid is a current liability. We have dealt with note number 4 and note number 5 because note number 4, note number 5 are affecting receivables. Note number 6 is about depreciation. We have dealt with that. And then note number 7, we are told included in salaries and wages is an amount of 93 paid domestic workers. We said this is part of the drawings. Finally, note number 8 is about outstanding wages. Outstanding wages is basically a current what? Is a current liability. So basically in our case, we don't have any other current asset. So what we need to do is we get the total assets. So the total assets, we add all this. Let's add all this. We have 2550 plus 752, 990 plus 505, 800 plus 200, 135 plus 516 for 20 plus 60, 300 plus 222, 600 plus 10.5. So I'm getting a figure of 4,818,745. 745. Is that what you're getting? Is that what you're getting? Paul? Yes, that is confirmed by Evans. That is confirmed. Yes. Now we said after getting this, we double underline. So double underline means what? We are based, that is the end of the first part. Because we are preparing this based on this equation, asset are equal to capital plus liability. So we are done with asset. So then from there, that's why we are underlining. That is the end of the first part. We proceed to record what? Capital. So we record capital here. And capital, that one, I think, is the first item within the trial balance. That is the first item within the trial balance, which is 4 million, 47, 48, and then 430. And then to this, remember, during the current year, we had a loss. Can you remember the loss? Yes. So in case you have a profit you add it to this. But in case you have a loss you less it. So the net loss for the year. The net loss for the year. Can you give me that net loss, which we got in our income statement? In this case, you may decide to have two columns here or one. You can't be penalized because of that. Sasa? Yes, you can use two columns or just one. You can't be penalized because of that. Sasa? Yes, you can't be penalized because of that. You may decide there are different approaches. Kuna mwalimu atafunza hizi current asset aziweke hapa, akuwe na column mbili. The current asset to be recorded here. Once you get the total, you take it. But in an exam, you can't be penalized because of that. What is marked in an exam are these final figures. The person who is marking will not be interested whether you have two columns or one column. Sasa? Yes. So you can't be penalized because of either using one or two columns. Sasa? Yes. So I'm given the loss here, which was 171,155. And remember, loss should be deducted. We said what is the rule? Any figure which is to be deducted, record it here inside the bracket. Sasa? Yes. Then to this, we also left drawings. Now, drawings, we have two. We have two drawings. So first of all, we have some drawings within the trial balance. I don't know whether you can see them. The drawings in the trial balance, just above the furniture and fittings. The drawings of how much? The drawings of 300. Can you see those drawings within the trial balance? Yes. Can you remember the other drawings? Who can be able to remember? We also have other drawings. I don't know whether you can be able to remember we have other drawings. Who can be able to remember those other drawings? Who can be able to remember the item to be treated as drawings? The item to be treated as drawings. The item to be treated as drawings is what? Is what we have in note number 7. What we have in note number 7. These salaries and wages which were paid to the domestic worker, to the domestic worker. That is basically like taking money from your business. You pay your personal expenses. That is a drawing. That is what? Drawings. It reduces the money you invested in your business. So that will give us what? That will give us a total drawings of how much? Total drawings of how much? Total drawings, 4,500. Yes. So then here we get the net capital. We get the net capital, or basically the capital at the end of the year. We work out that. We take the capital at the start, we less those two figures. 47, 48 minus 171, 155 minus 405, 300. I'm getting 4171, 975. Confirm whether that is what you're getting. Confirm. Is that what you're getting? Is that what you're getting? That's what you're getting? This minus that. Yes. So after getting capital, we proceed and record liabilities. We record liabilities. Liabilities, we classify them into two. Non-current liabilities and current liabilities. So here we always start by recording non-current liabilities. non-current liabilities. Non-current liabilities, we said that these are liabilities which are payable for a period exceeding 1 year. For a period exceeding 1 year. Now, we said in a sole proprietorship business, this can only take the form of a bank loan. The form of a bank loan. The sole trader, the only non-current liability a sole trader may be having is a bank loan. So if you check on the information which you're given, and also you have to recall, we said when checking for the liabilities, you check the items appearing on the credit side of the trial balance. That's why we have liabilities. So on the credit side, no, Easter, we have to finish. Let's finish, and then I'll give you a short prayers break. Let's finish this. It should take us 5 minutes. We finish, and then I give you a short prayers break. Yes, let's proceed so that we finish. I give you a short prayers break. Okay, so on the credit side, what do we have? Up there, I can see we have capital. We have sales. Are those expenses? No. And in fact, if you check on that trial balance, there is nowhere we are given a bank loan, because as I'm saying, the only non-current liability a sole trader can have is a bank loan. So there is nowhere we have a bank loan here. And then finally, we record the current liabilities. The current liabilities. Current liabilities, these are liabilities payable within a period of 1 year. We have a number of them. Equally, when checking for liabilities, check the items appearing on the credit side of the trial balance. So up there, I can see we have capital, and I'm checking the items appearing in the last column of the trial balance. I can see we have what? We have a capital. And then down there, you can see we have sales, we have the return outwards. Down there, you can see we have discount. Down there, you can see we have payables, trade payables. Trade payables is the first current liability, trade payables. How much is that? That is an amount of 483,600. And then below that, we have equally a bank overdraft. A bank overdraft is still a current liability, and that is 120,600. So you can see all liabilities, they appear on the credit side of the trial balance. Then down there, we have accumulated depreciations. Accumulated depreciations are not automatically liabilities. Then can we go to the additional information so that we wind up? In the additional information, number 1, we have dealt with that. Number 2, we have dealt with that. But if you go to note number 3, we have outstanding electricity. In this case, we say any expense not yet paid at the end of the year is a current liability. Any expense not yet paid at the end of the year is a current liability. And that is an amount of how much? That is an amount of 5370. So then below that, we have note number 4 and 5. We have dealt with that because those two notes were affecting receivables. Note number 6 is about depreciation. Note number 7 is about drawings. And then finally, note number 8, we equally have outstanding salaries and wages. These are still current liabilities. Outstanding salaries and wages, which amount to how much? Which amount to 37,200. And basically, in our case, we are done. So what we need to do here is we get the total capital and liabilities. Total capital and liabilities. Total capital and liabilities, how do we get that? We take capital, this one, and then we add all these liabilities. We add all those liabilities. We should get a figure which is same to this. Confirm that 41,71,975 plus 483,600 plus 120,600 plus 5370 plus 37,200. That should give us a figure which is similar to this 48,18,745. 745. Is that what you're getting? Is that what you're getting? Yes. So therefore, whatever you get here, basically should be the same with the total asset, because we are preparing this based on the accounting equation. Asset, this one must be equal to capital plus liabilities. Sasa, yes. So that basically what is required. I want us we have a short break, a short break, and then as we come back, I want us to look on another question. I want us to look on another question. This is a question I want you to have as we come back. We have a question here which was examined, I think, in the sitting of May 2017. May 2017, question number 4. Question number 4. Can you take that question just as I confirm? Yes, so that is a question. That is a question I want you to have as we come back. So we take that short break. We come back at exactly 7 so that we do this question. So let's take that short break. Yes, so what are we told? We are told the following trial balance was extracted from the books of Joyce Merrill as at 30th of April 2017. So we have the inventory as at 1st May 2016, purchases, return outwards, cash in hand, bank balance, building at cost, salary expenses, stationery, legal fees. We have allowance for doubtful debt, trade receivables and trade payables, salaries, capital, selling and distribution cost, discount allowed and discount received, sales, equipment at cost, rates and insurance, return inwards, accumulated depreciation on 1st of May 2016 for building and for equipment. So then we have additional information, number 1 all the way to note number 6. And then what are we required to do? We are required to prepare the income statement for the year which ended 30th of April 2017. And part B, we are required to prepare the statement of financial position of these sole traders. So what I want us to do, I want us first of all, we go through the additional information which are given from note number 1 all the way to note number 6. We do some few workings, and then from there we prepare what is required in part A and also in part B. So let's go direct to additional information number 1. Additional information number 1. Remember, this is a question for May 2017, and this was the question number 4. So we start with some workings as per the additional information. So what are we told in the additional information number 1? In the additional information number 1, you're told allowance for doubtful debt is to be increased to 5 million. Is to be increased to 5 million. So basically what we said is that during the current financial year, as far as the allowance or the provision for doubtful debt is concerned, we consider, or basically what we account for in the income statement is the increase or decrease. So what we need to do, we need to go back to the trial balance and you tell me how much is the provision for doubtful debt at the start of the year, because that is what that provision for doubtful debt at the start of the year is given. So the allowance for doubtful debts, allowance for doubtful debts. So we have the allowance for doubtful debts at the start of the year. At the start of the year, this is the allowance for doubtful debts in the trial balance. And then we also have the allowance at the end of the year. So we compare the two, and basically we determine the increase or the decrease. So can we go back to let's go back to the trial balance. And in the trial balance, where do we have the allowance for doubtful debt? The allowance for doubtful debt in the trial balance is, where do we have that? That is somewhere in the middle of the trial balance. I don't know whether you can see it, below the legal fees. So the allowance for doubtful debt in the trial balance, can you see that amount? Evans, Peter, Esther, Rin, can you see that amount? Yes, it is an amount of 35. That is the allowance for doubtful debt at the start. Then, if you go back to the trial balance up there, can you see what you're told in the trial balance up there? You can see the trial balance. We are given our figures up there in thousands of shillings. What does this mean? It basically means that all of the figures you're given in the trial balance, the last 3 zeros have been omitted. For example, in this case, the actual figure for this should be 3.5 million. should be 3.5 what billion. So for you to be consistent, what you need to do is that anytime you are taking a figure from the additional information, also omit the last three zeros for you to be consistent. Are we together? Yes. So now, once we go to note number 1, we are told the allowance for doubtful debt at the end of the year will be increased to 5 million. But because our figures are in thousands of shillings, for us to be consistent, we equally omit the last three zeros. So then what we do, we compare these two allowances, the allowance at the start and the allowance at the end. We determine, do we have an increase or a decrease? But in our case, we are told it is an increase. So we have an increase in allowance for doubtful debts over 1,500. So this allowance for doubtful debts, remember we said, or this increase in allowance for doubtful debts, we said is an expense. So any increase in allowance for doubtful debt is what? Is an expense. But if it was a decrease, we said it is recognized as an income. And then when preparing our statement of financial position, this allowance for doubtful debt, this one, 5,000, this one is what we left from the receivables. From receivables, we left this one, allowance for doubtful debt at the end of the year, not at the start, not the allowance at the start, not the increase. So we are done with that. Let's move to note number 2 because of time. If you're off somewhere, you just let me know. So on note number 2, we are told rates as at that is rates due as at that is of April 2017 amounted to 500,000. Rates are expenses. Rates due, these are expenses, or these are rates which were not yet paid. So in that note, we are told there were rates due. In other terms, these are rates which were outstanding, the rates which are not being paid. So those rates had a value of 500,000. I've said we need to be consistent by omitting in all the figures we are taking from the additional information, we omit the last three zeros. So these rates which were due, number 1, we will add this to the rates which had already been paid. We add this now to the rate in the trial balance. And number 2, these rates not yet paid, this one is a current liability. This one is a current what? Liability. This one is a current liability. Evans is saying the internet is not stable. I hope it is your internet, Evans. I hope Mwalimu's video is clear for the other. For Tina Paul, is Mwalimu's video clear? Paul, Mpate, Nicole, can you get Mwalimu's video clearly? Okay. Yes, Evans, maybe you can try to forward, even if your network is not working. You can try to just forward. Okay. So therefore, this rate not yet paid will be added to the rate already paid in the trial balance. And number 2, they'll be treated as a current liability. Number 3, inventory on that is April 2017 was valued at 52 million. This crossing inventory, this one we will use it in computation of the cost of sales. It is also a current asset. No working term. Number 4, we are told drawings amounting to 10 million have been debited to the capital account. Drawings amounting to 10 million have been debited to the capital account. So basically, to debit drawings, or if you're told drawings have been debited in the capital account, it basically means that these drawings of 10 million have already been deducted from capital, because remember we said a capital has a credit balance. Capital has a credit what? Has a credit balance. So if you're told an item was debited in this account, it basically means that reduced the capital. The capital. So it basically means that during the current year, this sole trader had drawings of 10 million, but those drawings have already been accounted for. Do we need to account for them again if they have already been deducted from the capital? No, we don't need to deduct them again from the capital. Alternatively, you can do this. You take the figure of the capital in the trial balance, and I think it's a figure of 116,800. You add this back then, this 10 million, but there is no need of doing that. Let's just ignore that, because these drawings of 10 million, they have already been deducted from the capital. So there is no way we are going to consider that transaction of 10 million. So the drawings have already been accounted for. They have already been deducted from the capital. So that note, we will not use it anywhere. Because essentially that's how we treat a capital. That's how we treat drawings. We let it from capital. We move to note number 5, and I want us to compute the depreciation. The depreciation to be charged is to be charged on cost on the foreign rate. So let's compute those depreciations. Depreciations. And we are going to start by computing the depreciation on buildings. In this case, we are told this will be 5%. And I hope you can see in paragraph 1, we are told depreciation will be computed based on costs. What is the cost of buildings in the trial balance? The cost of buildings. Buildings, where do we have them? We have somewhere in the middle of the trial balance. In the middle of the trial balance, the buildings have a cost of 50 million. I hope you can see that. 50,000 in the middle of the trial balance somewhere. Can you see that? Esther, Rin, Peter, can you see that somewhere? Hussein, Nicole, Mpate, can you see that somewhere? Yes. So then we will be able to compute that. We also compute the depreciation on equipment. Which is 10% of the cost. So the cost of equipment, where do we have equipment? Equipment, we have them downstairs. Downstairs somewhere, basically 5,000. So 10% of this is 500. 5% of this will be 25. 2,500. That should be the depreciation for the current year. Are you getting those values? Eunice, Esther, Rin, you're getting those values? Is that what you're getting? Is that what you're getting, Juma? Yes. So then finally, note number, this remember was working number 3, working number 4, in note number 6. In note number 6, we are told insurance amounting to 200,000 relate to the year which ended 30th of April 2018. So the current year, if you check on the requirement, ended 30th of April 2017. So we are told insurance of 200,000 relate to the following year. So which name will be given to those insurance? To those insurance expenses which relate to the following financial year. But automatically they were paid during the current year. Which name do we give to those insurance expenses or to that insurance expense? Paid during the current year, but it is for the next financial year. Yes, that one is known as a prepaid expense. So specifically prepaid insurance. Specifically prepaid what? Insurance, prepaid insurance of 200,000, over 200,000. So this 200,000, the prepaid insurance, number 1, this one will be treated as a current asset in our statement of financial position. And number 2, we less this from insurance expense. We also less this from the insurance what? Expense. We less that from the insurance expense. So that basically are the adjustment. Having that, I want us to quickly move now and basically prepare what is required. Starting with the part A of the question. In part A, we are required to prepare the income statement. So we have the name, the title. The title, we start with the name of the sole trader, Joyce Mero. This is the income statement. The income statement, basically, which is for the year, which ended 30th of April 2017. 30th of April 2017. So let's prepare this together. We prepare this together. So here we said we need to have two columns. We need to have two columns. And in this case up there, we will be able to indicate that our figures are in thousands of shillings. In thousands of shillings means that those figures which you're going to write here, the last three zeros have been omitted. The last three zeros have been omitted. So what do we start with here? We start with the sales. We start with the sales. When we have sales, remember you said sales is an income. We check this on the credit side of the trial balance. So the sales, I can be able to see that when we have the sales, it should be on the credit side. The sales, yes, I can see that somewhere above the equipment, below the discount around a discount received, which is an amount of 229,950. So to this we said we less the return inwards, or basically the sales return, the return inwards or the sales return. So the return inwards, do we have return inwards in our question here? Yes, I think there is somewhere. So, or was it return outwards? Do we have return? Yes, we have return inwards. From the bottom of the trial balance, above the accumulated depreciation, we have return inwards of 1550. We get the net sales here. We get the net sales. So the net sales will be 229,950 minus 1550. 228,400. So that will be our net sales. So after getting the net sales, we said we proceed and we compute the cost of sales, or basically the cost of goods sold. The cost of sales or the cost of goods sold. How do we compute this one? Quite simple. We take the opening inventory. To this we add purchases. To this we add purchases. We also add carriage inwards. Carriage inwards. We less purchases return. Purchases return, which is also known as the return outwards. And then we will be able to get something called the goods available for sale. After getting the goods available for sale, remember you said we proceed and less the closing inventory. But before we do that, can we record these items? So the opening inventory, this is the first item within the trial balance. In the trial balance, the opening inventory is 50,000. We have that working in the first column. So purchases is the second item within the trial balance. Is that a figure of 170,020? 170,020? Yes, I think so. 170,020. And then to this, we add carriage inwards. In this question, do we have carriage inwards? I've not seen carriage inwards somewhere. I've not seen carriage inwards. Eunice, Marine, do we have carriage inwards? I've not seen any. I've not seen any. Yes, but we have a return outwards. Return outwards, we have it up there in the trial balance. Up there in the trial balance, the third item, which is 46. 46. And then we will be able to get now the goods available for sale. The goods available for sale. So the goods available for sale here will be what? We have 50,000 plus 170,020 minus 4,600, which will give us 215 for 20. 215 for 20. Confirm whether you're getting that. Is that what you're getting? Yes, 215 for 20. Then to this, what do we need to do? What do we need to do, Eunice? Are you getting the same? Benson, Zuma, are you getting the same? Nicole, are you getting the same? I presume that is correct. That is correct. Okay. So then from there, what do we less? We less the closing inventory. Closing inventory is in the additional information. Additional information number 3. Additional information number 3, which is an amount of 52,000. Remember, in this case, we have said when taking any figure from the additional information, we must remember to omit the last 3 zeros. That's why you can see I'm taking that figure as 52,000, not 52 million, as 52,000. The figure which we get will be the cost of sales. We take it to the last column. So what will be our cost of sales here? Our cost of sales is 163, 420, 420. Confirm whether that is what you're getting. Are you getting that figure? Is that what you're getting as the costs of sales? 163 or 20. So we less that from the net sales. We less that from the net sales. 228, 400. And I'll get 64, 980. 64, 980, what is this? This is the gross profit. That is the gross profit, So after getting the gross profit, what do? To this, we add other incomes. We add other incomes. So the other incomes, in this case, include the discount received, include the decrease in provision for doubtful debts, include the rent received, the investment income, and so on. Now, when checking for incomes, also we said check the items appearing in the on the credit column, of the trial balance. That's where you get incomes. So just check the items appearing in the last column of the trial balance. So up there, you can see we have return outwards. Basically, that is not an income. Down there, I can see we have allowance for doubtful debt, but we said what we may consider here in relation to allowance is a decrease. If, for example, this was a decrease, we consider that here as an income. But in our case, it's an increase, meaning it's an expense. Down there, I can see we have payables. Down there, I can see we have capital. And then down there, I can see a figure of 46. That figure of 46, that is a discount received. That is a discount received. And in this case, you can see the examiner here basically try to catch you by basically giving those items together. Discount received, discount allowed. You have to recall discount allowed is an expense. If it's an expense, automatically discount allowed is the one appearing in the debit column. Discount received is an income, automatically should be on the credit side of the trial balance. That's what you just need to record there. Then down there, you can see we have sales. We have considered that here. And then we have accumulated depreciation down there. In the additional information, we don't have any other income here. So what we need to do is we get the total incomes. We get the total incomes here. Total incomes. Total incomes will be what? Will be 64,980 plus 46. Plus 46, I'm getting 69. 69, 580, 580, 580 like that. Yes. So then after getting this, we basically move and we less the expenses. We move and we less the expenses. We less the expenses. Now recall what we said here. Recall what we said. We said when dealing with the expenses, it is always advisable you start by deducting the expenses affected by the additional information. That's what we said. So we will first of all deal with these particular expenses affected by our additional information. Later on, we take the expenses not affected by the additional information. Let's go to note number 1. Note number 1 is affecting what? Note number 1, allowance for doubtful debt. We computed this increase. This increase we said is an expense. So we say here the first expense will be the increase in allowance for doubtful debt. So the increase is 1,500. It is an expense. So then below that, we have the rate. Rates is the one which is affected by note 2. And basically rates, we have rates which were outstanding. So the first thing we need to do, we go back to the trial balance, we check how much were the rates which were paid in the trial balance, because the rate we have in the trial balance are the rates which were paid. Where do we have the rates? The rates are given together with the insurance. So we have rates and insurance. Okay, so the rates and insurance is an amount of how much? Is an amount of 4,000. Is an amount of 4,000. So this rate, one, we have to add this amount of 500. These rates which were not yet paid, we add them. And also recall, we have an adjustment for insurance. Insurance is part of this. So the adjustment for insurance, I hope you can remember this prepaid insurance. We said we less that from the insurance. So to this, we less 200. We less 200. You can see those two adjustments for it. For insurance have been adjusted here because the rate and insurance are part of that. Then we get the final figure here. Final figure, which will be 4,300. 4,300. 4,300. 4,300. Is that what you're getting? Is that what you're getting? Rin, Esther, Eunice, Juma, Benson. Okay, so we are done with that. So let's move to note number 3. Note number 3 is about closing inventory. That has nothing to do with the expenses. Note number 5. Note number 4, we said this one will not have any adjustment because these were drawings which have already been accounted for. They have already been deducted from capital. So we don't have to account for them somewhere. Or we don't have to account for them here. So number 5 is about depreciation. We have these two depreciations. These are expenses. The depreciation on buildings. Depreciation on buildings is 25. Depreciation on equipment is 500 like that. 500 like that. So we are done with the note number 5. Note number 6, we also through with it because that was affecting insurance. And I think we have already dealt with insurance. So after doing that, what do? We go back to the trial balance, we pick the expenses which were not affected by the additional information. Sasa, yes. And basically for us to be able to do that, we have to recall that all expenses appear in the debit column. The first column is the trial balance. So let's check those items. The first item is inventory purchases. We have dealt with those. Down there, cash in hand, which is an asset. Cash bank balance is an asset. Building is an asset. And then below that, we have sundry expenses. Sundry expenses. So for the sundry expenses, that is an amount of how much? An amount of 840. So below that, we have the stationery. Stationery still is an expense. Stationery. These are the items which are used in the office, which is 1640. So below stationery, what do we have? We have the legal fee. The legal fee is still an expense. Legal fees, which is an amount of 280. And then down there we have receivables, an amount of 36, which is an asset. I can then see we have salaries. Have we dealt with salaries here? No. The salaries amount to how much? Amount to 39,000. 39,000. And then down there you can see we have selling and distribution. Selling and distribution costs. Selling and distribution costs, which amount to 1,600. And then down there you can see we have discount. Discount allowed is the one which appears on the debit column because that is an expense. Discount allowed, which is an amount of 6,000, 6,300. Okay, so then down there you can see we have equipment. Then below equipment we have rate and insurance. Remember, you've already dealt with the rate and insurance here. Rate and insurance, we have already dealt with that one. Then down there we have return and accumulated depreciation. So we are done with all the expenses. We are done with all the expenses. Basically, what we need to do is we get the total expenses, we take them to the last column, and basically we deduct them from our total incomes. I hope there is nothing we have skipped. Have we omitted any expense? I think no. Okay, let's get the total expenses. 15 plus 43 plus 25 plus 500 plus 840 plus 1640 plus 280 plus 39,000 plus 1600 plus 63. I'm getting 58,460. So we need to less this from our total income here, 69,580. And I'm getting 11,120. 11,120. Because that is a positive figure, that is a net profit for the year. A net profit for the year. A net profit for the year. That's what you're getting? Net profit. Net profit. Hussein, Rin, Eunice, Esther, are you getting that? Please confirm so that we proceed. Yes, confirmed. So let's move to part B. In part B, we are required to prepare the statement of financial position of this sole trader. A statement of financial position as at that year of April 2017. As at that year of April 2017. Yes, so here we start by recording assets, basically which we classify into two, non-current assets and current assets. Non-current assets and current assets. So in this case, I've said, let's just be using one column. I've said you can either use two columns or just one. You can't be penalized because of using two or one column. So let's just get used to using one. Because even at the higher level, once you go to financial, to CP intermediate level, you'll also be able to do this topic, financial statements, mostly of a published company. You'll be using one column, including the income statement, you'll be using one column. Yes, so let's just get used to one column. So which non-current asset do we have here? We have a number of them. Also remember assets. Assets have a debit balance. So I'm told that the profit is 111. 11. The profit is what? No, Zuma, is that correct? Is our profit this one? 1120. No, Zuma, that is not correct. Our profit is 11,120. That is our profit. That is our profit. Yes, confirmed. Okay. So let's record now the non-current asset because of time. Because of time. So non-current assets, they have a debit balance in the trial balance. So which non-current asset do we have? I think first of all, I can see buildings. I can see buildings. 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 Can you see buildings somewhere? Up there? Yes. So what is the cost of buildings? The cost of buildings is 50,000. 50,000. To this cost, we left two items. We left accumulated depreciation at the start. Remember what you have done in the other question. I've given you a starting formula, which I've said is very, very important. Accumulated depreciation at the start, which is in the trial balance, and the depreciation for the current year, which is an expense here. So the accumulated depreciation at the start is in the trial balance down there. Down there, the last item in the trial balance, 11,400. And then I will also less the depreciation for the current year, this one. So that I get the net book value at the end. So that I get the net book value at the end. That one you must understand it, because I know this is one of the area majority of the students don't get it wrong. Eunice, can you understand what you're doing here? Esther, Rin, can you understand what you're doing here? Yes. This is one of the area I know majority of the students encounter a problem. How do we compute the value of an asset at the end? You take its cost minus the accumulated depreciation at the start minus the depreciation for the current year. So which other asset do we have? I can also see we have equipment down there. Equipment, the cost is 5,000. I will less the accumulated depreciation at the start, which is 1770, and also the depreciation for the current year, which is 500. So that I get the net book value at the end. Minus 1770 minus 500. I'm getting 2730. 2730. Is that what you're getting? 2730. Confirmed. Okay. So I don't think we have any other non-current assets. I can't see any other non-current asset. Or do we have any other? Do we have any other non-current assets? Do we have any other non-current asset? I can't see any. So we move and record the current assets. The current asset. So which current asset do we have? So within the trial balance, first of all, I can see inventory, purchases, cash. We have cash in hand. Cash in hand is 13. And I hope that is 400. Is that 13,400? Yes, I hope so. It is 13,400. So then below that, I see bank balance. So for the bank balance is 32,660. 660. Then below that, I can see building, sundry, stationery, legal allowance, and then I can see trade receivables. So for the trade receivables, this one will be having some adjustment. We will take the trade receivables of the receipts, and then we less the allowance for doubtful debts at the end. This one. So we don't less the increase or the decrease or the allowance for doubtful debt at the start, but we less the allowance for doubtful debt at the end. Which is 5,000. That will give us 31,000. Then below that, we have salaries, selling and distribution, discount, equipment, rates. Yes. Then we go to the additional information. In the additional information, number 1, we have dealt with that. Note 2, we have rate due. These are rates not yet paid, is a current liability. And then note number 3, we have the closing inventory. So closing inventory, we recognize it here as an asset, 52,000. Number 4, we said no entry for that. Note number 5, we have dealt with that. Note number 6, we have prepaid insurance. Prepaid insurance, which is 200. So remember, you have said when taking any figure from the additional information, remember to omit the last 3 zeros. So then we get the total assets. So let's add all those assets. That is 6,100 plus 2730 plus 13,400 plus 32,660 plus 31,000 plus 52 plus 200. I'm getting 168,090. 168,090. 168,090. Is that what you're getting? Yes, that is confirmed by Eunice. So then from there, what do we need to do? We proceed and record capital. So provided you remember to double arrange that, we record capital. And here we start with the capital at the start. The capital at the start of the year. The capital at the start of the year, where do we have that capital? We have capital in the middle of the trial balance there, which is a figure of 116,800. So to this number one, we not less, rather we add this profit for the year. Net profit for the year. Net profit for the year, which is 11,120. Now, do we have drawings? Yes, we have drawings, but those drawings have already been deducted from this capital. Now, I was seeing the other option in terms of how we can account for those drawings is, first of all, you add them back to this capital, such that our original figure for capital will be 126,800 after adding back the amount of 10,000, which is in note number 4, and then you less them again. But no need of doing that. Is there any need? You add 10,000, you less it again, no need. So therefore, what we will do here, we will get the net capital. The net capital is basically the capital at the end, which will be 920, 120, 127, 127, 127, 127. Yes, so then from there, I want us to proceed and record liabilities. We start with the non-current liabilities. Non-current liabilities, you have said, in case of a sole trader, these can only take the form of a bank loan, And I don't think we have a bank loan in this question. We don't have a bank loan anywhere. There is nowhere we have a bank loan. So finally, we record the current liabilities. The current liabilities. So the current liabilities the end of the year, which basically the end of the year, which basically is an amount of 500. So then below that, we have inventory, we have dealt with that. Drawings, we have dealt with that. Note 4. Number 5, we have dealt with that. Number 6, we have dealt with that. We are done. We are done. So basically what we need to do here is we get the total capital and liabilities. Total capital and liabilities. We just take this figure here, which is capital. We add these to liabilities. We should be able to get the same figure as this. You're getting one what? 168, 168,090. So basically, which is the same with this one. Are the two figures reconciling? Are they the same? Or in other terms, is our statement of financial position balancing? Yes, it should. It is balancing. It is basically balancing. So that is it. That what is required. So by doing that, the marks allocated there were 10. So how is this question marked? So what is marked are these entries? These final figures here. These are the figures which are marked. Basically, those are the figures which should give you what? 10 marks. We should give you 10 marks. Yes. So basically, we are done with that topic. Preparation of financial statements of a sole trader. It basically means that once we meet in our next class, we will be able to move to another topic, I'll be able to see which topic we will be able to cover next. But now remember, moving forward, the topics we will be covering are all about preparation of financial statements. Like we're going to look on how we prepare financial statements of a company, of a partnership, of NGOs, not-for-profit making organizations, manufacturing entities, and so on and so on. But for today, I want us to stop at that point. I don't know whether there is any question before we wind up. And I hope you have understood that topic. Have you understood what you have done as far as that topic is concerned? Have you understood that topic? Have you understood that topic? Eunice, Duma, Benson, Esther, have you understood what you have done here? Have you understood what you have done here? Have you understood what you have done here? Yes, yes. So that is it. So maybe you can just take those particular questions which you have already done with you, and you try to attempt them again on your own without necessarily checking on what you have done here. Sasa? Yes, yes. So I want us to stop at basically at that point. We continue from there in our next class. And also we are requesting you to continue supporting us. So if you know someone who has not yet enrolled or basically gone back to college, doing this particular CASNEB courses, please refer that student to us. We will be able to appreciate. Yes. So we stop at that point for today. We continue from there in our next class as we move to a different topic. So have a good night. See you next class.